This is real John AG. One name, one handle, two platforms, that's it. If you're looking for me, you'll find me under OG John AG on X and on YouTube. Anything else floating around out there is noise. Recycled charts, borrowed talking points, or someone trying to package this format and sell it back to you with an affiliate link attached. Here's the reality. Anyone can copy a style, anyone can repeat numbers, but they can't fake positioning, they can't fake data access, and they definitely can't fake having real exposure when volatility hits. The one thing they can't replicate is the handle, so verify it. And more importantly, watch this entire video. If you can't sit through 10 to 12 minutes of structured analysis, you're going to miss the part that actually matters. Every section builds on the last. Skip ahead and you'll lose the thread. And today especially, context is everything. Now let's talk about what just happened. In the last video, I told you to watch the gap. I laid out the numbers clearly. While Western spot markets closed on Friday with silver at 93 and gold at 5,278, the physical-backed crypto markets kept trading through the weekend. No pause, no closing bell, real-time price discovery while COMEX slept. Kinesis silver was trading near 100. Hyperliquid printed 96. PXG gold was hovering around 5,400. That wasn't random noise. That was a preview. I said it plainly. Precious metals were likely to gap higher at the open. And that's exactly what happened. Silver jumped from 93 to nearly 97 on the open. Gold punched through 5,400. The premium told you before the bell rang, but here's where things get complicated and far more important than the gap itself. Because now silver is sitting at 90. Gold is around 5,346. So what happened between the euphoric gap higher and the sudden reversal? That story is the entire point of this analysis. This morning wasn't just volatility. It was a live demonstration in regime dynamics. Who leads, who lags, and why markets behave in ways that don't make surface-level sense unless you understand what's actually driving the machine underneath. Let's start with China, because while U.S. markets were stretching and getting ready for the opening bell, China was already in motion, and not quietly. China's largest e-commerce platform adjusted gold prices this morning to the equivalent of 5,574 per ounce. Let that number settle in your mind for a second. 5,574. Western spot, as I'm recording this, is sitting near 5,346. That alone is a major divergence, but then it escalated. Physical supply started disappearing. Major retail gold outlets across China stopped selling standard investment-grade gold bars entirely, completely halted. The only products left available were decorative or craft bars, smaller pieces priced at the equivalent of 6,229 per ounce. That's roughly a $1,000 premium over Western spot. That isn't a chart anomaly. That isn't a futures contract dislocation. That's physical scarcity showing up in real time in the largest gold-consuming nation on Earth. And then the system buckled. Jingdong Finance, which runs gold accumulation products in partnership with domestic banks, experienced severe congestion when markets opened. Users couldn't log in. Orders couldn't process. The platform stalled under pressure. Think about the scale of that. China holds approximately 336 trillion yuan in household savings. When even a fraction of that capital attempts to shift into gold at the same time, infrastructure cracks. That's what we saw this morning. Every major Chinese bank reported a surge in gold buying. Every major Chinese gold miner hit daily limit-up levels. This wasn't quiet institutional positioning. This was a stampede. And here's the part Western investors should be paying attention to. Chinese mining stocks were limit up. Western miners not following. Historically, miners amplify the move in the underlying metal, sometimes 3 to 5 times. When gold moves, miners usually move more. That's textbook behavior in a strong, confirmed bull regime. So when Eastern miners explode higher and Western miners hesitate, that divergence means something. It's either an opportunity or it's a warning. And the people who do their homework instead of reacting emotionally will figure out which one faster than everyone else. Now zoom out, because this isn't just about safe haven flows. The macro backdrop changed fast. Iran has now struck 15 different countries or military installations. Count them: Israel, the United States, the UAE, Saudi Arabia, Qatar, Kuwait, Jordan, Iraq, Bahrain, Oman, Syria, Cyprus, and French, Italian, and British military positions. This is no longer a contained regional flare-up. This is a multi-front escalation hitting critical global energy infrastructure simultaneously. Saudi Arabia's Ras Tanura refinery, the largest in the kingdom, processing roughly 550,000 barrels per day, halted operations after drone strikes. At the same time, Iranian drones targeted Qatar's Ras Laffan energy complex, one of the most critical liquefied natural gas hubs in the world. Qatar Energy halted LNG production. Qatar accounts for nearly 20% of global LNG supply. Gone. European natural gas prices surged 47% in a single day, the largest one-day increase since Russia invaded Ukraine in 2022. That isn't algorithmic noise. That's a market pricing genuine supply fear. Meanwhile, reports surfaced that Kuwaiti air defenses shot down U.S. F-15E fighter jets. The United States canceled roughly 41% of scheduled Middle East flights. And the president publicly stated, "We haven't even started. The big one is coming soon." So let's summarize the reality. The largest Saudi refinery, offline. Qatar's LNG production, offline. Hormuz shipping, effectively frozen. 15 countries directly engaged. 30% of global oil supply disrupted or at risk. And oil prices are falling. Let that sit with you. 30% of supply under threat. And crude drifts from 73 down to 70 after an initial 8 to 9% gap higher. That's not fundamental speaking. That's positioning. That's concentrated paper pressure holding the surface steady while physical stress builds underneath. Mark Douglas wrote in Trading in the Zone about the difference between what a market should do and what it actually does based on positioning and control. You're watching that lesson unfold live. The paper short stack in oil is buying time. But reality doesn't disappear just because futures contracts say otherwise. And this connects directly back to what I said in the last video. Paper markets and physical reality are separating. We saw it in silver's weekend premium. We're seeing it in oil suppression despite catastrophic supply shocks. We're seeing it in China's physical gold shelves literally emptying, while Western spot prints calm numbers. Now here's where things split, and where understanding this moment becomes critical. Gold is green on the day. Silver got slammed. At the New York Open, silver was aggressively pushed below 90 before full liquidity even came online. Why? There are two explanations. Both matter. The first is macro-driven. This is a supply shock, not a demand boom. When supply shocks hit energy markets, they create growth fears. Slower growth expectations hit industrial demand projections. And silver isn't just a monetary metal. Roughly 50-60% of its demand comes from industrial applications. Solar panels, electric vehicles, electronics, AI infrastructure, defense systems. If global growth projections wobble, silver feels it. Gold doesn't. Gold is purely monetary. No factory requires it. No production line depends on it. In growth scare regimes, gold leads. That's textbook. But here's the second reason. A nearly 8% drop from the highs concentrated right before the New York Open isn't just macro. That's macro with a hand on the scale. When silver closed at 94, sentiment flipped instantly. Social feeds lit up with all-time high predictions. Moon calls everywhere. Maximum bullish confidence. And I said this would happen. When markets move 5-10% quickly, sentiment swings violently. When it peaks, you often get the opposite move, a flush that clears out late entries and resets positioning. That's what today looked like. A sharp shakeout, 5 to 10% down. Retail conviction rattled. Sentiment is a weapon when you control size. And when you look at who holds the largest position in SLV right now, the picture gets more interesting. We'll get into that next. Because understanding who has size and how they operate is critical if you want to navigate what comes next. This isn't just geopolitical escalation. It's financial warfare layered on top of military escalation. Iran isn't just launching drones. It's targeting economic choke points, ports, refineries, LNG terminals, tanker routes. Precious metals aren't reacting to headlines. They're reacting to what informed capital understands about regime shifts. Now we need to talk about positioning, liquidity control, and the 150 EMA level that silver just bounced off, because that line may decide whether this was a reset or the start of something deeper. Let's pick up exactly where we left off, because this isn't about panic, it's about structure. Pull up the hourly silver chart. Add the 150 period exponential moving average. When silver was slammed to 88 right at the New York Open, that's precisely where it found support, right on the 150 EMA. Not randomly, not loosely, precisely. Since then, it bounced back toward 90. That level is critical. If silver loses the 150 EMA on the hourly and fails to reclaim it quickly, downside opens toward 84.9 and possibly lower. That number isn't dramatic, it's mechanical. It's where liquidity pools sit. It's where weak hands who chase 94 start to capitulate. But here's what matters more than the Western chart. Shanghai spot silver is still sitting around 102. Western spot, around 90. That's roughly a $12 premium. And that premium survived the New York Slam. Shanghai futures are around 105. So even after the aggressive sell-off in U.S. trading hours, the East-West premium remained intact. That tells you something important. Physical demand in Asia hasn't blinked. The paper price went down in the West, but the conviction in the East didn't evaporate. If anything, the divergence became clearer. And now we need to talk about positioning. Because a 7 to 8% drop from highs in under 2 hours is not just macro pressure, that's liquidity engineering. Do you know who currently holds the largest position in SLV? Jane Street, roughly $1.3 billion. Now don't misunderstand this point. This isn't about labeling them bullish or bearish. Large institutional quantitative firms don't think in emotional directional narratives. They think in edge extraction. When a firm of that size accumulates a position, they are not passive. They are not hoping. They are not guessing. They are operating. Algorithms are built to exploit predictable human reactions. Push price high enough to trigger breakout buyers. Reverse hard enough to force liquidations. Harvest volatility. Repeat. They profit from chaos. You profit from clarity. Two entirely different games playing out on the same chart. This morning looked like a classic liquidity sweep. Maximum bullish sentiment into 94. A fast gap higher. Then an aggressive reversal to reset positioning and test structural support. And this is where intellectual honesty matters. There is a real bearish case short term. Silver filled its gap. Silver broke momentum. Western mining stocks did not follow Chinese miners higher. If the 150 EMA fails on the hourly, price can absolutely revisit 84.9 and potentially probe deeper liquidity pockets. Those are real risks. Gap fills are common. Sharp reversals after euphoric sentiment spikes are common. Growth scare regimes do hurt industrial metals first, but now let's separate noise from structure. China experienced a physical gold buying stampede that crashed its largest e-commerce platform. Retail gold bars sold out. Banks reported buying surges. Chinese gold miners hit limit up. Shanghai maintains a double-digit silver premium. Physical gold in Chinese stores is roughly $1,000 above Western spot. Qatar's LNG production is offline. Saudi Arabia's largest refinery is offline. European natural gas just posted its largest one-day surge since 2022. And oil, despite 30% of global supply disruption, is being held down in paper markets. That combination is not random. When oil is suppressed during supply chaos, when silver is slammed during peak sentiment, when physical premiums hold while paper fades, you are looking at regime friction, paper versus physical, west versus east, positioning versus reality. Now let's talk about the metal hierarchy in growth shock environments. In a classic risk-off supply disruption regime, gold moves first, silver follows later, platinum lags, copper struggles the most. The more industrial exposure, the more sensitivity to growth expectations. That's why gold is holding green on the day, while silver absorbed the volatility. Gold doesn't require economic expansion. Silver partially does. So gold leading right now is not weakness, it's sequencing. And sequencing matters. Now here's the question that sits over everything. Does informed institutional money know something ahead of the crowd? Oil suppression despite catastrophic supply disruption. Silver slammed before the New York Open. Concentrated size in SLV. Eastern physical markets running hot while Western paper markets wobble. These events cluster. Markets do not move randomly at scale. Someone is either buying time or preparing for repricing. And if silver holds this 150 EMA on the hourly and stabilizes while Shanghai premiums remain intact, the next move higher could be far more violent than the last one, because it would occur after weak hands are cleared. If it fails, then 84.9 becomes the battleground. And you'll hear panic everywhere from the same voices who were screaming moon at 94. That's how sentiment cycles operate. Extreme optimism, violent reset, doubt, then repricing. The structural silver deficit hasn't vanished. 10 consecutive monthly green closes before this week didn't disappear overnight. Energy infrastructure damage doesn't reverse in 24 hours. And 336 trillion yuan in Chinese savings didn't suddenly decide gold was unattractive. Short-term volatility does not invalidate long-term pressure. But it does test conviction. Right now, we're in a regime where gold is asserting monetary dominance first. Silver is being forced to prove itself technically. Oil is being artificially restrained while physical stress accumulates. And geopolitics are escalating faster than headlines can keep up. That's not hype, that's structure. So here's the approach. Watch the 150 EMA on silver hourly. Monitor Shanghai premiums. Track oil behavior relative to supply disruption. Ignore emotional narratives. Trust data. If you want real-time updates as this develops, follow John AG on X. I'll post numbers as they come in between videos. Don't trust personalities. Don't trust hype. Trust positioning. Trust structure. And above all, invest with logic, not emotion.